So with our IUL products, currently these are the only two products that our long-term care rider is available on. That is our Income Advantage IUL, which is our accumulation-focused product. So this is the product that people would use if they want to overfund the IUL policy to use that cash value for later use. And then our Life Protection Advantage IUL is strictly, it's more protection-based, so more for people who want life insurance but want the potential to build some cash value in the policy. Both of these products use the S&P 500 as the index, and they use an annual point-to-point crediting method. Our philosophy is the simpler the better. I mean, we don't want to confuse agents and clients with fancy crediting methods, etc. We just want it straightforward and simple, and it's been working for us. So both of these use the same crediting strategies with slightly different participation rates and caps. So the Income Advantage has 100% participation, and that would be credited currently at 11.5%, a higher participation cap at 140%, and that is 8.5%, and then an uncapped, which is 65%. And then the Life Protection Advantage, kind of same thing, a high, low, and an uncapped, and you can see the participation rates and the caps on that product there. So both are designed to be very low cost and have the same fixed and index loan options available. And we're proud to say there's been no changes to the caps or participation rates since we launched these two products. And, we want to be very transparent. We even publish what our participation rates and caps are and what we actually have accredited in each segment on our website, so you can see exactly what's happening with these policies. One of the things that really set our two IUL policies apart is our guaranteed refund option rider that is included with these policies at no additional cost. The way this works is there's 7 60-day windows in which if the client wanted to, they could surrender their policy and receive their premiums back. Now, this is like a backup option, so if the market doesn't perform the way it should, which is not expected at all, but it is a safety net, and it makes the clients feel more comfortable that if they're putting all this money into a policy and the market's not performing, they can get their money back. So the way that works is in year 15, they can get 50% of their premiums back, and in policy years 20 through 25, they can get 100% of their premiums back. Both of these policies also include an accelerated death benefit rider for terminal or chronic illness. That's included at no cost and with no additional underwriting. So think about it like this. If they, and I'll talk more about this in some upcoming slides, this rider is automatically included. They don't have to pay for it. But if they apply for the long-term care rider and they get it, then this rider is not included with the policy. So they can't have both on the policy, the accelerated rider and the long-term care rider, but they're definitely going to get this accelerated rider if they don't qualify for the long-term care. So again, it's a nice option to make sure that that client is covered either with the chronic illness acceleration or the long-term care rider. And keep in mind, Mutual of Omaha, United of Omaha is an age last birthday company, so we treat people as their actual age, not their age nearest. And that definitely comes into play in certain scenarios. Okay, so this is the Income Advantage. We introduced this product in March of 2016, and since then, it's always hit the cap on both the 100% participation rate and the higher participation rate of 140%. And at the no capped auction, you can see we've credited a maximum of 13.75% during any particular segment, and then a minimum of 7.35. So that's actually an average of 10.66%. So still very good on any of the strategies that people choose. And they can actually choose multiple strategies. They don't have to have all of the money going into one strategy. It can go 50% in the 100% participation rate and 50% in the 140 if they want, or split it up however they want. So they do have some flexibility there. But I think where we really shine is when we look at the comparison of the accumulation on this particular product. Now, again, we're talking about the Income Advantage product currently. So let's say we have this client. He's a male, age 50, preferred non-tobacco. He wants $1 million of level death benefit. He's going to pay $20,000 annually for 15 years. So he's overfunding this a little bit, and he only wants to pay the premiums for 15 years. So over that 15 years, he pays a total of $300,000, and he chooses the point-to-point in a 100% participation rate. Okay, so let's look at some cash values here, because I do think this is very important when you look at us compared to some of the other carriers. So the cash value accumulation in year 10, 20, and 30 is shown here. And we also are showing this based on the maximum illustration rate that each carriers will allow. So when you look at Mutual of Omaha, we're the third one down, the 10-year cash value that's built up is almost $229,000, which is significantly higher than all of the other major competitors that we're showing there. Again, same thing when you look at the cash value for the 20-year, we're right up there, $550,000. There's only one carrier that's a little bit higher, but yet again, they're showing a illustrated rate of 7%. And even at the 30-year, when you look at us compared to all of the other carriers, we're right in there at 993,000 plus, given our illustrated rate at 6.72. The other ones that have higher cash value have a higher illustration rate. So this really goes to show you how competitive we are with this particular product. And then I also want to show you how we compare the fees. So all of these policies have internal fees that are built into this policy. So what this is illustrating here is that we have the same client that we looked at before, same amount of premium for everybody. So everybody has put in $20,000 annually for 15 years. And then what this is going to show you is the total fees that have been charged over the last 20 years. So if you look at Pacific Life, as you can see, their fees are very high. And then you see the other carriers there compared to United of Omaha's internal fees just over $81,000. So we're very, very proud of the fact that we're able to keep our fees lower. What that does, it enables the policy to be more likely to illustrate true to the illustration versus being skewed by some of the internal fees. Here's just another example. I really like this one just because it really illustrates how low that our fees are compared to all the major carriers out there in as far as what they charge for their fees. So as you can see, we have one of the lowest fees out there at 27% is going towards charges. 73% is actually going towards the investment part. Okay, so that's that blue category there. And then I really like this one too, because what this shows is based on a 20-year rolling average of the S&P 500 between 1950 and 2016. This is the average rate that would be needed to achieve a cash value of $500,000 by year 20. So Mutual of Omaha, our policy would need a 6.02%, where all the other carriers would need a higher percentage in order to get that $500,000 of cash value. Okay, so keep that in mind. Again, what I'm showing here is how competitive we are with the Income Advantage product. Let's talk a little bit about the index loans and how they're a little bit unique. You know, some companies use index loans to make the illustration look better. So when the loan charge isn't guaranteed, the company can raise it by as much as you want, and that could substantially impact the actual income the client receives. Mutual of Omaha, we put a cap on our loan charge. We want to make sure that we're consumer friendly. Everything is upfront, so the client knows exactly that their loan charge cannot be more than 6%. Ever. I mean, we've made that a rule. Currently, it's at 4%, and again, it's guaranteed to never be higher than 6%. I talked a little bit about the Grow Rider before, and again, chances are this Grow Rider won't matter. It won't come into play, but again, a properly funded policy with a proper market performance, you know, the cash surrender should be just fine, be a lot higher than what the premiums paid. But again, it's a safety net for the clients. If they're skeptical, it does make them feel a little bit better. Okay, let me talk a little bit about the Life Protection Advantage IUL now. This is, again, the protection product. So this product has a long-term no-lapse protection premium that's guaranteed to age 85. But typically the guarantee does go beyond most people's life expectancy, and coverage beyond 85 is available on a non-guaranteed basis. Okay, so this is a good illustration of what the average life expectancy is for a male and female at that 85% rate, but want to show you that this product is still very competitive, and because of our low-cost fees, I'll show you how that illustrates out. But first of all, if you've heard about this product when we first released it, wanted to make sure that you realize that we did change our premiums. We lowered them in April of this year, in some cases by 25%. And we still maintain our extremely competitive position when you solve for premiums to carry to age 120. So I just wanted to illustrate this for you so you could see where we took the decreases in the premium. When we released it, we just, quite frankly, didn't have the pricing right. So we're quick to realize when we made a mistake, and we're quick to fix it. All right, so what this illustrates here is the long-term no-lapse protection premium. So you see here United of Omaha's long-term no-lapse protection premium, just over $87,000, and our guarantee is to age 85. Okay, so you look at the premiums of the other carriers. They're almost right in line with ours. There's a few that's a little bit more. Okay, and then if you also look at their no-lapse guarantee protection, you know, some of them are at 90, some at 85, some significantly less. But if you look at how long the death benefit is projected to last you, given a 4% crediting, ours is at 97, which is higher than all the other carriers except for John Hancock. But again, they're paying significantly more premium. And then if you look at a crediting of 4.5%, again, we're all the way out there to a guarantee to 103. And again, everyone else is below that except for John Hancock. So we're very, very proud of this, and all of this happens because of our low internal cost within this policy. Again, this one also has the guaranteed refund option, the accelerated death benefit for chronic illness, and there's no changes to our low-cost structure. So if you want to know more about the base IUL policies, we have a website that you can go to. It has a ton of information out there on each specific product, some calculators. So I definitely recommend, if you're interested in selling this product in combination with our long-term care rider, just go out there, play around with it, see what's out there. But again, I wanted to first cover the basics of the IUL products before I started to talk about the long-term care. So let's get right into the long-term care then. So this is a rider that's, again, available only on our Income Advantage and Life Protection Advantage. We will be releasing this product and other products in the future. However, we wanted to release it on the IULs first, make sure that everything is going smoothly, and then we'll release it on other products at a later time. This is a reimbursement rider. So we'll pay a benefit based on actual expenses. There is an opportunity to access all or a portion of the life insurance death benefit early for these long-term care expenses. And we released this rider July 1st, so it's been out there just a little over a month. It reimburses for bathing, all of the activities of daily living or severe cognitive impairment, so that's the triggers. And there's a 90-day calendar elimination period. So, that includes nursing home, assisted living, home health care, adult daycare, bed reservation, respite care, and hospice care. So basically all of the things that a traditional long-term care would pay for, except for a cash benefit. But remember, this is a life insurance policy that builds cash value. So if they needed to take cash out of the policy, they certainly can do that. There's also care coordinator services as an option if they want to use the care coordinated service. What they do, I'm sure you're familiar with this being in the long-term care business, but it just helps develop an individual plan of care for the client. And when they use the care coordinator, again, they can have caregiver training, durable medical equipment, home modifications, or a medical alert system. This does allow for 2 times the monthly maximum benefit for stay-at-home benefits, okay? And there's no elimination period for these services. So how does the long-term care impact the life insurance policy? Well, if they don't use the long-term care rider, the beneficiary will receive the full death benefit. If the long-term care rider is used and we pay out benefits, that reduces the death benefit dollar for dollar. So if we pay out $20,000 in long-term care benefits, the death benefit's going to be reduced by $20,000. And then the accumulation value is also reduced proportionately to the long-term care rider benefit received. And if the long-term care rider benefits are exhausted, there's no long-term care rider benefits payable. Okay, so let's talk about the maximums that people can get for their long-term care rider. Okay, so we have an acceleration that's available at either 1, 2, or 4%. So they tell us what they want at the time of the application. So if they have a $200,000 life insurance policy and they have a 4% rider, that's going to be an $8,000 maximum monthly benefit. They have a $1 million policy at a 4% monthly acceleration, that's $40,000 maximum monthly benefit. So keep in mind the most that a client could ever get is $50,000 for the long-term care benefit, okay? All right, so the upfront cost, so it's an upfront cost, so there's no discount on the back end. So they're paying these rider charges as part of the cost of insurance, and the long-term care rider cost of insurance rates are guaranteed not to increase. And then once they're receiving long-term care rider benefits, the rider charges are waived. So they still have to pay for the life insurance policy, but they don't have to pay for the long-term care rider. Okay, so this is available for ages 30 to 79. It's not available for Table 4 or anybody who has flat extras on the life insurance policy. Now, we do write these policies separate, or we underwrite the long-term care rider separate from the life insurance policy, and it has its own risk classes. So the long-term care is either preferred, standard class 1, or standard class 2. The nice thing is that our life underwriters underwrite for the long-term care rider also. So it prevents delaying issuing the policies because there's no handoff between a life underwriter and a long-term care underwriter. Our long-term care staff has fully trained our long-term care riders on how to underwrite this policy. Okay, so FIT credits. What FIT credits are is they're a credit program on the life insurance in which if the client meets certain criteria, they can get a potentially a better class on their life insurance. But the FIT credit doesn't apply to the long-term care rider, so just keep that in mind. Now, I mentioned before that if they have the long-term care rider on their policy, they qualified for it, they passed underwriting, they don't get the accelerated benefit rider for chronic illness on their policy. But if they don't qualify for the long-term care rider, they still will get this chronic illness rider included at no additional cost. So that's an added flexibility that other competitors don't offer. And think about this. If you're working with the client, you've sold them, talked to them about this IUL policy, they really like it, you talk to them about the long-term care rider, they want that too, but if they just don't qualify for that long-term care rider, this chronic acceleration is a great option for them. It's still there. They can use it as a backup plan, and you don't have to go out and talk to them about another carrier because this is a backup option for them. All right, so other highlights and features. The target minimum and no lapse premiums will increase in conjunction with the rider, okay? And the Grow rider is still available on all policies. So that's that guaranteed refund option rider. It's available on all of these policies as, again, that backup plan. So right now, we have the long-term care rider and approved in all the states shown there. We've added a couple August 1st, Arizona and South Dakota. We're still waiting on a few approvals. If you see the note there in the bottom, the states in blue are expected soon, and the states that are not approved yet in black lettering are expected to take a little bit longer. And that should be no surprise. California, Florida, Hawaii, Montana, and New Jersey are always notorious for being slow in approving products. So again, expect some more releases from those other states here. As far as the long-term care rider marketing support goes, we do have a long-term care information underwriting guide. It's a very detailed booklet, similar to what you're used to seeing on our traditional long-term care side. There is a long-term care client brochure We even have a brochure that's a combo brochure with our IUL products that shows information on the long-term care rider. And we have a lot of training that's available on our website as well. So we've created some brain chart presentations that'll give you an overview of the rider, talk about reimbursement versus indemnity, planning ahead for long-term care, and we have some brochures with some sales ideas and some flyers. So how do clients protect their assets and leave an inheritance, or selling the long-term care rider, chronic illness versus long-term care rider. So there's even some out there on licensing requirements. So as far as Mutual of Omaha is concerned, you do have to have a life license and a health license, and you have to have done your long-term care training, continuing education training. So keep that in mind as well. If you're only contracted with Mutual of Omaha for our health products, so only for long-term care, for example, or Medicare supplement, you do have to be contracted for our life products as well, specifically for the Income Advantage and the Life Protection Advantage. And that's just a matter of a transmittal being submitted by GoldenCare to us, so there's no new paperwork that needs to be filled out if you're contracted with us already. It's just a matter of adding those life products to your contract. Okay, so with any life product too, there's anti-money laundering training that needs to be done. If you haven't done that in the past, you would need to do that as well. So you can find all of our marketing material on our microsite that we have available. It's a new long-term care rider website. There's the address on the screen, just mutualofomaha.com/LTC-rider. It includes all the long-term care information and materials that you would need. There's a long-term care rider presentation out there, additional sales ideas, and information on cost of a care coordinator. So keep that in mind. All of this is available to you at no cost. There's even some information of national costs and state averages for long-term care, a cost of care calculator, which I'm sure you guys use this, but just to know this is one that's out there as well. Okay. So that's all I had for the presentation, but I would be more than happy to answer any questions. I do see there's a question in the chat bar. It says, will the PowerPoint be sent out to the attendees? I can certainly send that or make that available.
There, at one time showed www Brain Shark or something, but it wasn't up there long enough. What is that website?
Oh, let me go back here so I can show you that.
Brain Shark.
Okay, so these are just additional training. So like after this presentation, for example, if you want to review some of the things that I've just talked about, there is a presentation, a Brain Shark presentation out there that you can review. Basically, all the Brain Shark is a PowerPoint presentation that has a voice recording that talks. So you can, it'll flip through the slides for you.
Thank you.
Yes, Sandy, Jeff Clark here again, GoldenCare. Just wanted to thank everyone for coming on board again. Sandy, great job on that. If you need any more materials on this or product brochures, you can certainly call us here at the marketing office at GoldenCare, and we'll be happy to get stuff to you. Number here, of course, is 800-842-7799, or you can email supplies@goldencareusa.com and request an application pack for the new product. And I want to personally thank everyone for coming on board today to learn about the product, and also thank Sandy for doing a great job presenting. And if there's anything else out there, I'll go ahead and just, I guess, shut the webinar down. Sandy, you have anything else to add? Or?
No, nothing else to add except that if you have any problem quoting, the IULs, you can always contact GoldenCare, and they would be able to help you and get you an illustration.
Okay, then, well, listen, thanks everyone for coming on board. You can also probably find a recording of this webinar in our archive at goldencareagent.com. And again, just another thanks for coming on board today. And give us a call at the Brokerage office and let us help you sell this new life product. Thanks a lot for coming, and thanks, Sandy.
You're welcome.